Hi, I'm Jackson Vaughan. I'm one of the co-founders and managing partners of Konvoy Ventures. We are a gaming-focused venture firm. And today I'm going to be talking a little bit about the emergence of industry-focused VC firms in general. So jumping into the conversation here, the reason why I'm talking about this is we launched a gaming and industry-focused VC firm on the gaming space in 2018. And since then, we've grown to managing over 200 million with 7 employees or so, primarily based in Denver and truly dedicated to the video gaming industry and its growth at the earliest stages. But to understand sort of why industry-focused funds like ours have emerged over time, I think it's important to go into the sort of brief history of venture capital. So in the early or mid 1800s, there was sort of this invention of financing whaling and funding whaling expeditions that looks honestly a lot like venture capital does today. And there's a couple of great books you can read on this. But essentially, groups would come together and they would finance these whaling expeditions, these ships with these captains that would go out and go whale hunting. There's huge amounts of risk involved in these expeditions. You know, entire ships could be lost at sea. And it really was akin and looked very similar to what venture capital looks like today, where you have groups funding startup companies with management teams that are building companies and trying to create incredible value, but most do fail. The few that do go well have huge returns, and just like that, the same thing happened in the whaling industry, where you had incredible returns from the few ships that came back with barrels and barrels of oil. Now, this actually eventually helped the U.S. whaling industry secure, I think, over 75% of all whaling ships by the late 1800s, which is an incredible feat, and it's truly financial engineering that enabled that. Now, when you sort of fast forward to the early 1900s, you have the turn of the century, and you've got sort of the Gilded Age families funding risky ventures. And it's not just whaling anymore. You've got manufacturing, you've got factories, you've got all sorts of industrial activity and new inventions being pursued. And you really have these large families that are funding the initial seed capital, the risk capital for these ventures. Now, in the 1940s, after World War II, you've got a professionalization that starts to happen across venture capital. There's a lot of technologies that have been developed through the war, and there's need for funding to advance them and develop them further. You actually have some of these Gilded Age families, like the Vanderbilts and the Rockefellers and the Whitneys, create more, put their firms into. Instead of investing for the family, they actually create corporations. So you've got, J.H. Whitney, for example. You've got the Rockefeller Brothers Incorporated, which we'll get to later, but actually becomes Venrock, which is a renowned VC firm. But they become institutional investors rather than just investing the personal family funds, and they start raising capital. The first of which, the first fund that actually comes together on this front is the American Research and Development Corporation, ARDC, and they actually raised public funds in the late 40s, based out of Boston, and well connected within the education system within Boston and Cambridge. And so you've got Boston and then New York as well. And then you've got the introduction of actually VC in the Bay Area starting in the 50s with Davis and Ruck, another venture firm. And in the later 50s, you actually have ARDC turning some $70,000 investment into a $300 million over the period of 10 or 15 years. And so that was sort of the initial proof point from a professional standpoint of this model actually working. Not just working, but actually really knocking it out of the park. Now, sort of fast forward through the 60s, you've got a whole slew of new venture funds that start picking up. You've got Sutter Hill Ventures, you've got asset management company Mayfield, Venrock actually gets put together, Greylock, CRV, and you've got an incredible amount of new venture firms that are doing quite well and professionalizing the industry. Now in the 70s, you've got Sequoia, Kleiner Perkins, Bessemer, NEA, all these incredible firms come together as well. And by the end of the 90s, you have over 300 firms managing some $20 billion. So this firm really gets professionalized between these periods. Now, in the 90s, you've got the start of the internet age. Before that, we had the semiconductor industry, the personal computer industry start to develop, and venture capitalist firms financing that. But in the 90s, you start to see companies like Netscape and Amazon and eBay and PayPal and Netflix and Google start to pop up. And the focus was really the internet and how to access it and how to bring it to people on their personal computers. Of course, we hit the dot-com boom then in the 90s and the dot-com bust shortly thereafter. And I think a lot of people wondered sort of what went wrong and how do we improve and figure out how to better operate venture capital in this model. And we started to come up with alternative approaches in the early 2000s around accelerators. You had things like YC Combinator pop up, and this notion of value add with venture capital, where it's not just capital that you're getting, it's not just money, but it's actually platform. This notion of platforms comes about where groups are helping you with hiring and coaching and business development and things of that nature. Now, if we look to today, just change slides here. If we look to today, how is venture capital growing and evolving as an industry? Well, there's a few areas. You have new asset class creation actually. So you've got things like debt actually entering the VC vernacular. You have things like revenue-based financing. And these are modifications, to be honest, on the business model. And some might not even view these as true venture capital. But for solving the problems of early stage startups who need capital to seed their ideas, debt and revenue-based financing, for example, do solve that issue. So it's not traditional venture returns in that business model, but this does become an option and an alternative for startups. Now with vertical and horizontal scaling of the VC offering, what you have here is sort of what I was mentioning in the last slide of firms offering their platform to help startups. Now, this can be recruiting and hiring. This can be business development. This can be accounting and back office support. With larger and larger funds being raised, you have additional management capital with these funds to help support their portfolio companies. We've seen this, over the 2010s and the growth of this with Andreessen Horowitz, for example, where they've done an incredible job of creating this back office support that really supports portfolio companies as they grow and as they scale. So another area that some firms have expanded into is pursuing sort of what I view as the aggregated index approach for early stage tech startups. And the general idea here is in traditional venture capital, you invest in some 20 to 30 companies and you hope that a few really do make it, and they're going to cover the cost for everything else. In more of this index approach, some I think negatively view it as the pray and spray model, but you can invest in even more, investing in hundreds of startups per year, and really taking an index on the early stage tech market or even in specific submarkets. You see this, for example, with 500 startups where they invest in, on average, some 200 plus companies per year. And this is sort of an approach where you're viewing, hey, the entire market for early stage startups is going to grow. We don't necessarily need to invest in only the best, or we might not be well positioned to invest in only the best. Let's just take an index of the entire aggregated market, and we should have returns. And then the next one I'll mention here is technology driven. As startups invest in technology, I think they see the power of technology. Sorry, as venture capitalists invest in technology of startups, they see the power of technology and how that can potentially help them differentiate and get better returns. So you've got things like research-driven technology firms that have maybe 12 people on staff versus 30, and they're able to through pursuing aggregated information, scraping off the internet, things of that nature. They're able to sort of pick out signals for what is working, what's not, what is growing across the internet, and they're able to sort of bubble up themes, bubble up different individuals that might be starting companies, things of that nature. You've got recruiting-focused platforms within venture capital. Signalfire is a great example of this, where they have a tool set that is similar to a CRM, but it helps their portfolio companies find talent to hire, and that's really quite differentiated. And no one else has a recruiting tool of their nature. You also have network-driven platforms like NFX that provide a network offering to the industry where investors can meet founders, and founders can have profiles, and everyone can it's a matchmaking service in a sense. And of course, they tap into all of that data and are able to see who's gaining traction and who's not, and being able to cherry pick off of that. So beyond technology and these other ones, you also have what the focus of this conversation is today, which is the industry-focused firms and funds. And that's what I'll jump into in this next slide here. So what is industry-focused investing? There's sort of this notion of a lot of business innovation, or maybe even most business innovation, is just simply bundling and unbundling offerings and products. And when you think about that in the context of venture capital, you have firms like Andreessen Horowitz, A16Z, bundling the VC offering by further expanding horizontally and vertically in their platform offering. They're able to provide more capital for their companies for a longer period of time. They're able to help them with operations of the business, things of that nature. They're leaning into, hey, we're not just going to give you capital, but we're going to figure out how you should spend that capital and how we can make that capital go longer for you. On the other side, you have sector-specific VC funds that are unbundling venture capital as a landscape. So instead of focusing and being a generalist on everything, you can create value by being focused and specifically targeting one industry. Now, the general idea here is that it's just division of labor. I think there's this notion within venture capital of being a Renaissance man or woman, and the idea there is, hey, you can learn and do everything, right? You can focus on everything. And VC really did start as generalists investing across all industries. But as the startup landscape becomes more complex and more VCs are entering the VC market, it becomes incredibly competitive, and it becomes honestly quite difficult, and from our perspective, too difficult to be a generalist investor and actually know what you're investing in. Whereas if we move towards division of labor and we, as an industry, have specialization, we can achieve more with that focus. So what does that actually look like, though? And why does it make sense? So the thing with focusing on a specific industry is that you develop expertise. If you're spending all day, every day, working within biotech, for example, you're really going to understand biotech, and you're going to become an expert in it. Beyond that, you're also probably going to develop really strong deal flow, and this is connected to the notion of network, right, which is on both of these. The more people you talk to, whether they are startups, whether they are industry people, whether they are other investors, the better understanding of the market you're going to have, and the stronger deal flow you will develop. The more people you ask for specific deal flow in a given area, the more you'll likely get. But not only that, because you have expertise, you're seen as smart within that specific industry. And this is something we spend a lot of time on at Konvoy, where we talk to a lot of people across the industry, whether that be at public companies within gaming, whether that be at early stage with early stage startup founders. The more we talk to people, the more we understand. The more we understand, we actually are quite public about our learnings, and we run a newsletter, for example, on gaming and the gaming market and where we see it going. And this helps us be seen as a industry leader and an expert. And that underpins not just deal flow, but also brand. And all these things, as you can start to see, become interconnected. And we've developed a firm here, and a lot of other industry-focused funds have developed the same type of firm, where you become an expert. You become the one-stop shop for a lot of startups that want expertise. They want smart capital as they venture forward and start building their companies. So that's an overview of why industry-focused venture capital has come about, and why we think it makes sense, and why we're doing it at Konvoy. I hope that was helpful. Thank you.